Hey everyone, welcome back to my channel. If you're looking for a powerful but easy to understand strategy to make money in volatile markets, especially crypto, then you've come to the right place. Today, we're going to talk about grid trading and how you, even as an individual investor, can use a quant-style approach to earn profits from price swings. Best part? You can automate a lot of it. Now before we dive in, do me a quick favor. Smash that like button, subscribe, and turn on your notifications so you won't miss any future updates that could turbocharge your portfolio. Ready? Let's jump right in. So first off, what is grid trading anyway? In simple terms, grid trading means you set up multiple buy and sell levels, often called grids, at regular price intervals. Whenever the market moves within your predefined range, the strategy automatically buys low when the price dips and sells high when the price goes up. Over time, you potentially pocket the difference in these little trades. According to Binance Academy and Investopedia, this approach is popular because it taps into market volatility, something you see a lot in assets like Bitcoin or other cryptocurrencies. Why volatility is your friend? If you think about it, in a steady, non-moving market, you're not really making many buy or sell orders. But when the price is jumping up and down, your grid strategy is constantly buying and selling, racking up profits from each small swing. That's why it's super important to pick something that's historically known to be volatile, like crypto, certain tech stocks, or even commodities that see frequent price fluctuations. Let's break it down step by step, nice and easy. Pick a volatile asset. For instance, Bitcoin has significant daily price movements, so it's often a go-to for grid strategies. Stocks like Tesla could be another example if you're on the equity side. Set a price range. Let's say Bitcoin is trading at $30,000. Maybe you predict it won't go below $6,000 over the long haul, just a hypothetical. So you decide your grid range is roughly from $6,000 to $40,000. You set up several mini levels in between, spaced at intervals, like every 1% move, automatically buy and sell. If Bitcoin's price drops by 1% from your last buy point, the system buys a little more. If it goes up 1% from your last sell point, the system sells a bit to lock in some profit. This continuous process of buying low and selling high is done automatically by a trading bot or a system that monitors the market 24/7. Profit depends on price fluctuations. Essentially, each microtransaction profits from these tiny ups and downs. If Bitcoin keeps bouncing within, say, $20,000 and $35,000, your grid keeps making trades and collecting the difference. According to CoinDesk, many traders who adopt grid systems use automated platforms that let them sleep easy at night while the bot carries out the repetitive tasks. Let's say you have $10,000 for your trading strategy. You decide to run a grid on Bitcoin. Here's a hypothetical breakdown. Buy at current price. You put 50% of your $10,000, that is $5,000, into Bitcoin at $30,000. Upward moves. For every 1% increase in price above $30,000, you sell 1% of your Bitcoin position. That means if the price hits $30,300, 1% up, you sell about 1% of your BTC holdings. If it hits $30,600, 2% up, you sell another 1%, and so on. Downward moves. The remaining $5,000 is held in cash. So if the price drops 1% to $29,700, you use 1% of your cash to buy more Bitcoin. If it drops another 1%, you buy another portion, etc. Your system or bot needs to be configured to do this automatically. Many exchanges or third-party providers offer grid trading bots. You just plug in your parameters and they handle the rest. Now let's talk about the elephant in the room. What if the price crashes beyond your lowest grid? That's the biggest downside. If the price just keeps going down, you'll be buying the dip all the way, and eventually, you might run out of cash or hit your grid's lower limit. To offset that, you might invest 5% of your portfolio into a long-term put option. What is a put option? A put option is basically a contract giving you the right, but not the obligation, to sell an asset at a certain price within a set time frame. It acts like insurance. If the asset price crashes below that strike price, your put can help offset those losses by rising in value. For more details, check out CME Group's educational resources on options. They explain how options can hedge against downside risk. setting a wide grid. Some traders go really wide, like 80% below the current price for the lowest buy level, so the grid rarely gets breached. Of course, in crypto, never say never. That's why the put option is an extra layer of protection for those black swan scenarios. Markets aren't static, so your grid shouldn't be either. Maybe Bitcoin's price goes up a lot over the course of a few months. You might need to shift your entire grid upward so you're still capturing the daily volatility. Conversely, if it keeps drifting downward, you might realign your grid to capture new price levels. Monitoring your strategy. Even though a bot executes your trades, you're still the pilot. Check in periodically to see if your grids are still relevant. Look at macro factors. Is there a Federal Reserve announcement that could pump or dump the market? Is there a new regulatory shift in crypto? By staying informed, you can readjust your grid before the market drastically changes. Real-life example. Imagine you set a grid from $20,000 to $40,000 for Bitcoin, believing it'll keep oscillating in that zone. But after a big piece of news, like institutional adoption, it skyrockets to $45,000. Great, you made some profit on the way up. Now your entire grid is below the current price. If you don't shift it, your bot might not place any new sell orders, so you bump the range to $30,000 to $50,000. Now you're back in action, capturing those 1% swings again. A lot of people hear the word quant and assume it's only for professional hedge funds. But that's not really true anymore. With modern trading platforms and AI-driven tools, individuals can implement systematic strategies right from their laptops. According to a research overview by the Journal of Portfolio Management, algorithmic and rules-based trading continues to grow in popularity among retail traders as technology becomes more accessible. The power of automation. Having a bot monitor markets 24/7 means you don't have to stare at charts all day. It executes according to your plan. No second guessing, no emotional breakdowns. Emotional trading can lead to panic selling or FOMO buying. A rules-based approach sets you free from these pitfalls. Earning a side income. Grid trading, if done properly, can be a great way to generate some additional income from assets you're already holding. But remember, volatility is a double-edged sword. You're counting on price fluctuations to make money, so if the market becomes super stable, or if it crashes too far, your profits can stall, or even turn to losses. Start small. Don't go all in on your first attempt. Use a fraction of your capital, maybe 10 to 20%, to get comfortable with the process. Pick the right exchange platform. Look for an exchange that supports grid trading bots or allows you to connect via API. Binance, KuCoin, and many others have built-in grid functionalities. Make sure to choose a reputable platform that fits your location's regulations. Study historical volatility. Check how your chosen asset has behaved in the past. Websites like CoinGecko or Yahoo Finance provide historical charts. See if the asset's price movements fit your preferred strategy. Set reasonable grids. Don't space them too narrowly or too widely. Narrow spacing might result in tons of tiny trades and high fees, while spacing them too far might miss out on frequent small profits. Implement a hedge. Consider that 5% allocation to put options or any other form of hedging. If your asset is super volatile, having insurance can help you sleep better at night. Review and adjust regularly. Markets change, so should your grid. Schedule a weekly or monthly check-in to see if you need to recalibrate your levels. Think long-term. Even though you're profiting from short-term swings, keep an eye on the bigger picture. Make sure your overall portfolio aligns with your long-term financial goals. Grid trading can be a game changer for anyone looking to profit from market volatility, whether it's crypto, stocks, or other assets. By setting up a series of buys and sells, you'll be able to capture those price swings automatically, letting you live your life without constantly checking the charts. And hey, if you're worried about a colossal crash, put options can be your safety net. If this video gave you a new strategy to explore, do me a favor. Hit that like button. It helps this video reach more people. Subscribe to the channel for more actionable tips on quantitative strategies and personal finance hacks. Comment below. Have you tried grid trading before? What was your experience like? I'd love to hear your stories or any questions you might have. Thanks so much for watching. Remember, There's always a creative way to make money in the markets if you stay informed, stay disciplined, and stay open to new ideas. I'll see you in the next video. Take care and happy trading.